Doing well this morning. Thanks
Good.
for coming in.
Thanks for having me.
Welcome to the podcast. And why don't you tell the people about your business?
Cool. So I own Montana Family Mortgage. So we do residential mortgages all across the state of Montana. Small brokerage. We're kind of a map dot when it comes to a lot of the mortgage places out there. It's myself and I have 5 other loan officers. So we're very, very small compared to most places. But that gives us some competitive advantages in overhead. When it comes to size and how many people we have and the overhead we have. We don't have 6-story brick building on Front Street to pay for or huge office space to pay for, et cetera. So we end up we're able to kind of take that savings and roll it into rates, et cetera. So
Right.
yeah.
Right on. And you've been operating in Montana for how long?
Yeah, so we opened in 2017. Kind of have a little bit of a circuitous route to mortgage. I was in law enforcement in Missoula for about 10 years.
Okay.
Then my wife and I owned a home care company for about 9 years. We had W-2 employees that would go into homes and help seniors.
Right.
So we owned that for a while, and then I ended up getting into mortgage in 2017. And we ended up selling the home care place. My wife is actually a loan officer now as well with me. And yeah, now this is our full-time gig.
What made that jump going from a law enforcement to home care to loans? It seems
Yeah.
I could maybe see the jump between law enforcement and home care.
Sure.
You know, it's caring for people
Yeah.
in a way, but
Like
A
I
mortgage
said,
broker?
very circuitous. So, as far as I think it started back with law enforcement, in the capacity that I was actually working at the time, was a very exciting position. I loved working there, but I would get a call from my partner that would say, "Hey, we're going to Butte in a half hour. I'll pick you up."
right.
And I'd say, "Okay, when are we coming back?" "I don't know. See you in a half hour." So I now tell my wife and my young son, "Hey, I'm packing a bag. I'll see you sometime. Bye." And it was not necessarily conducive to a healthy home life.
Right.
At the end of the day, I've been with my wife since high school. Our son is now 16. At the end of the day, it was more important that I focus on my family, on my son, on my wife, than my career. And even though I love the career, my family's more important. So took the jump to home care. I severely underestimated how stressful home care was.
Okay.
We had 89 W-2 employees, and we could have hired 10 more at any given day for those 9 years.
Wow.
Just hiring the quality of people that we felt comfortable putting in others' homes. We had extremely high standards that we would not compromise on, and so while it was a self-creating problem a little bit, it was very stressful. So I'm looking for something else to do and diversify a little bit. And I've always been a little bit of an entrepreneur. We've had 4 or 5 businesses. And I'm talking to a good friend of mine who's a realtor, and he said, "Hey, you should do real estate." Looked at real estate and thought, okay, the skill set you need to be a successful realtor, I don't have. So no, that's not going to work. And he said, "Well, you know what you should do? You should do mortgages." I said, "Okay, I have a mortgage, and that's my experience level." So I started to look into that. I actually have a good friend who is probably the biggest independent mortgage broker in Missoula County. Talked to him, sat down with him for a little bit, went through everything, and thought, okay, there's a lot to learn. There's a lot that you have to figure out, a lot that you have to do, a lot of avenues that you can take, but you can really kind of make this business your own. I've never been one to shy away from hard work, and I've also never been the one that thinks I know everything. So I am the one in the room that will stand up on a chair and say, "I don't know what the hell I'm doing. Someone help me figure this out." And that's the approach I took when we went into mortgage. And first came into the world and took the test, did all the testing, which you know as well as I do with the real estate test. The test is simply a test. It doesn't tell you how to do the job.
Not at all.
And then I started to really look at the people within the industry, looked at some of my referral sources, whether it be realtors or title people or insurance agents, and really started to learn from them a little bit. I'm a quick learner, and I'm not always the smartest guy in the room, but I'm not too bad. And after several years, I got very, very good at this. And the thing I love about mortgage is 1 + 1 = 2. And no one can argue with math. And while I never was a math guy growing up, the wonderful part now is that when I get buyers, especially first-time home buyers, or especially people that are sitting on the fence, not knowing do they enter the market or now, if I can have a little bit of their time and I can do the education piece of it and I can break down home appreciation versus interest rates versus their wage increases, etc., and I can math it out for them, when they're sitting on the fence on do I buy now or wait, and they let me have that conversation, they will buy now because mathematically I can prove why.
Right.
So that's what I love about mortgage. It really is communication. It really is math, and it really is customer service. And that angle of it too, I think we win on all day long because everyone says that they have great customer service and everyone is full of it. Let's be honest. So we really try to focus on that aspect of it because we're not the Stockman Bank. We don't have a huge advertising budget. We're not Rocket Mortgage. How do you think they pay for all of those ads and all those billboards and all those things like that and their CEO?
Right.
They roll it into their rates.
Yep.
So we take the approach of, hey, we're going to have the best rates out there. But in order to get business, we just need to be good at what we do. So, I mean, we have the most 5-star Google reviews in the entire state of Montana, and we are tiny.
Awesome.
If we don't do a good job, if people don't appreciate and like what we're doing, if we're not transparent, we don't get business. So that's kind of the philosophy we roll on.
It's a great philosophy.
There you go.
I think it beats advertising for sure. I mean, you could advertise all day long and not have great customer service, and
That's true.
well, people are going to be dissatisfied.
There you go.
So, being in the mortgage industry, it's been in the news quite a bit over the last couple of years since rates have started coming up. They raised historically fast, and that's put a lot of pressure on home buyers, and I'm sure it's made life in the lending business a little more complicated.
Yes, it has.
So tell me about the experience of what it's been like since we've gone from historically low interest rates to one of the fastest rising rates that we've seen in this country.
And you hit the nail on the head. Sorry about that.
No worries.
You absolutely hit the nail on the head in where we came from, and that's what's creating the issue.
Yep.
1971 to 2024, the average nationwide mortgage rate for a 30-year fixed rate conventional, 7.73%. As of yesterday, 7.375 was the national rate.
Yep.
Okay? So we're not doing bad.
No, we're back to
Yep.
more or less the average historically.
But the problem is when you come from 3%,
Yes.
2.99 to 7.3, oh my God, the sky is falling. Compound that with the house prices.
Yes.
I think everyone will agree house prices are high. So it's very interesting trying to educate people because I think one of the biggest challenges I have as a mortgage broker is my dad said this, my aunt said, my uncle said this. Everyone's dad, aunt, and uncle told them that the housing market is going to crash.
Mm-hmm.
It's not going to happen.
I don't think so either.
Everyone said, oh, rates are going to go way back down. No, look at the 50-year average. Yes, they are going to go down. I agree with that. But they're going to slowly trickle down, and the economy has to support the decrease first.
Right.
So when you really look at all of those factors, rates are a pain in the butt because people are used to the 2.99%. It still has to factor into your life. Debt to income ratio. We've all heard it. Some of us understand it. Essentially what the government does, Fannie Mae, Freddie Mac, they're the entities that back all of these traditional loans, right? They're the ones that say you have to have a certain debt to income ratio in order to buy a house. That's the back end of what we go on. Those are guidelines. Essentially, how much do you make versus how much are you spending? The best debt to income ratio, they say they want 45%. That 45% hasn't changed. It was still that way when rates were 2.99%. They're still that way right now. So even though house prices are high, even though rates are high, the debt to income is still what it always has been. So in theory, even though, yes, you are paying way more now than you were a couple of years ago, you still can't buy a house unless you qualify based on your income and you're still having that good solid debt to income ratio.
Right.
So even though maybe it's harder to stomach those higher payments, people can most of the time still get into a house.
Okay. So what sort of things have you seen? Well, I guess how have you adapted your business to deal with Have you had any adaptation of the business, or is it simply just working with the people and showing them clearly what they can't afford these days?
Great question. It's all about the clients and the customers and what their mindset is, right? So the adaptation has absolutely been going from a 2.99% world where it's like, oh my God, my phone will not stop ringing. I will not stop getting inquiries. This is crazy. To all of a sudden people going, I'm not buying. There's no way I'm going to buy with rates like this.
Right.
And so much of the adaptation has come from, why are people saying that? Well, they're saying that because the payments are higher.
Yeah.
So let's start educating people on, yes, I know payments are high, but if you wait, it's called a cost of waiting analysis that I do. If you wait compared to buying now, what is going to happen? And painting that picture for them, because so many times people think, I'm just going to wait for rates to drop and that is it. That's part of the factor.
Right.
So I think the adaptation comes from just really the need to educate people, the need to overcome the objections that they have gotten from their parents, from their grandparents about rates, about house prices, about the market crashing, needing to overcome all of that, and also the education of our referral network being a lot of realtors sometimes, and hey, how can we utilize different products, different services, different kind of structures in mortgages to still help people get into homes?
Okay.
So you have various different programs, 3-2-1, 2-1 buy down programs. You have buy before you can sell programs. You have various different ways to still help people get into homes that maybe weren't as prevalent several years ago when rates are 2.99 because you didn't have to be creative.
Yeah. Okay, well, let's break that down a little bit. That interests me. The what do you say, the cost of waiting analysis?
Yep.
So what does that look like? Say I'm a buyer that comes to you and I'm not really sure that I'm able to either make the payment or if I even want to buy right now because I'm waiting for interest rates to come down.
Sure. So typically what I'll do on a cost of waiting analysis is it's about a 15-minute conversation. And what I do is I will get what your income is, what you're making right now. I will get your raise schedule. Typically people get a raise or they're open for a raise once a year unless they're commission or bonuses, whatever. So I get their income schedule. Then I will look and I will see, okay, do you rent? How much is your rent or do you own a house right now? How much is your payment, et cetera? And then we will look at the current market interest rate, which you know as well as I do, changes literally 15 times a week.
Yep.
But we'll look at it at that given moment in a vacuum, and we'll look at what the interest rate is. Now we'll look at a house price. And I usually pick a very round number. I'll say, hey, okay, this house right here is $500,000. This is the interest rate. If you bought it now, this is your payment. And I'll mark all that out. And I'll say, okay, now let's say you wait 1 year, okay? And let's say in that 1 year, rates go down. And rates go down 0.75%, which we know based on history. When rates go up, they jump up. When they go down, oh my God, it is a slow and painful trickle down. So let's say that it drops in 0.75%. That's great, right? You're going to save money because your rate dropped by 0.75%. Here's what people don't take into consideration. House appreciation. Now, that's also why I customize it for each person, because if we're looking at appreciation in the Bitterroot versus Mineral County versus Missoula County, they're all going to be different appreciation rates, right? So for the sake of this conversation, I'll say, let's take 6% house appreciation. So you have that $500,000 house and you waited 1 year. What ended up happening? Well, that same $500,000 house is now, $530,000 1 year from now. Same house. Nothing changed. It didn't get up and move. It didn't paint itself. Nothing changed. But now it's worth $530,000. But your interest rate, man, hey, you dropped 0.75%. Let's figure that out. 0.75% reduction on interest rate versus a $30,000 increase in price. And you would be amazed at how many times people go, oh boy, look at that. I'm actually paying more or about the same if I wait a year, even though interest rates dropped. Because you need to figure out the appreciation.
Right.
And then you smack them over the head with this. By the way, you know that $2,000 a month that you're paying in rent? Add on another $24,000 that you lost because you paid that to rent. And guess what the interest rate is on rent? 100%.
True.
So you just paid $24,000 in rent and you lost out in $30,000 of equity in your home if you would have bought it now. So even though the price is maybe the same, maybe a little higher, maybe even a little bit lower, You lost out on $24,000 plus $30,000 in appreciation. You lost out on $54,000 and your rate changed by $8 a month. Is that really worth it? Math.
Yep.
Right? That's why I love it. And every now and then you will get something where it works out where it's like, they're like, well, hey, yeah, but I'm getting a 15% raise next year. Cool. Let's factor that in. You know what? You should wait because it's going to be a better idea for you to wait XYZ. But those are very, very few and far between.
Right. Yeah.
And here's the thing. There's no one blanket statement. If there is any blanket statement that I can say is real estate has never in the history of America been a bad investment. As long as you don't use it as a short-term investment.
That's true.
You know?
Yes.
10-year. If you take it and you take a 10-year chunk of history and you cut it any way you want, residential mortgages or residential real estate has never lost value.
Very true.
Okay. So, I mean, if you're going to be in your house for 1 or 2 years, maybe renting is a good idea. If you're going to use this as a vehicle to create your individual wealth profile on yourself that is going to be the best investment you've ever done, the best time to buy real estate was yesterday.
Couldn't have said it better myself.
There you
go. With the increase in house prices, it's been more difficult for people to, get to the point where they can make a down payment.
Yes.
What kind of suggestions do you have for people that may be challenged to find enough money to make a down payment in order to take that step?
Great question, man. That is a big problem right now.
Yeah.
It really is, with the house prices skyrocketing so much. So you need to take advantage of as many programs as you can. But let's pause there and let's talk about some of those programs. Ryan, I don't know you real well. If I said I'm going to give you 10 grand, think there's a catch?
Oh, absolutely.
Absolutely. There's
Absolutely.
a catch. I don't really know you, and you seem like a cool dude, and you do a podcast, and you got an awesome beard that I can't grow. But I'm not just going to give you $10,000 without a catch.
Yeah, it's probably like 50% interest on it or something.
So many of these programs that are put out there are really, they're either teaser programs to get people interested, and people are going to contact whatever that entity is and say, hey, I'm interested in this program. And then they're going to say, yeah, well, only 1 out of 87,000 people qualify for this program. Thanks for calling, but I can help you with this instead.
Right.
They're a teaser, they're a bait and switch, they're things like that. So you get a lot of first-time home buyers that are like, hey, I want to use this program. It's like, cool, I know you want to use this program, but you make $27,000 more per year than this program allows. And then they sometimes get really angry because, well, I thought I could. No, again, it's a teaser thing. It's a program that's put out there. So you have to get creative with things. First and foremost, if you are a military veteran and you qualify to use your VA loan, my God, use it.
Yeah.
VA loans are my favorite loan out there, bar none, hands down. I will stand on top of a mountain and scream the benefits of a VA loan all day long.
Oh, I think they're widely misrepresented.
Absolutely.
Or misunderstood,
yes.
Actually.
Yes. And a lot of it comes from they used to be a big pain in the butt. And realtors historically have not loved them for a couple reasons. One, 28-day turn time on appraisals, 28 business days. We were the longest in the nation. We are now tied with the longest in the nation with 21, but it's still a little bit better. Also, the VA loans a lot of times people think they take a long time to close.
Right.
If you go with one of the entities, USAA, Veterans United, something like that, Navy Fed, please understand that they have that in their name to solicit business. They are not directly affiliated with the military. They're not going to do a better job, and I will promise you they will also not close on time. They will not. I've been in this industry long enough now, and I've talked to enough realtors. They say those entities do not close on time. You're going to take 45, 60 days to close.
Right.
My average 2023 VA loan from the time I got the buy-sell until we were cleared to close was 21 days last year.
Nice.
They're very good programs. You just got to know what you're doing, and you got to be on top of them.
Right.
So the VA is great because zero down payment. Don't have to have a penny as a down payment to go in. Rural development, USDA loans and rural development, it's the same thing. Zero down. Now the catch there is there's household income, there's personal income, there's a couple income standards that you can't make too much to be able to utilize it. And honestly, that puts it in a tough position right now with the home prices, and you can't make too much, and your debt-to-income ratio is actually less than that 45% on rural development, so it's even more difficult to get in. It's a very tough one right now, and honestly, I don't see it in this area of Montana. One of my loan officers kills it in Butte and Anaconda with it
Okay.
because the housing prices are just much better.
Yeah.
In this area, Bitterroot, Missoula, I haven't done a USDA in probably 2 years in this area. Butte, all the time.
Okay.
So that's great because it's 0% down. Okay, now we've exhausted the standard government zero down programs. Now what? The best program out there for the first-time homebuyer, bar none, is a 3% first-time homebuyer conventional program. 30-year fixed. It is a fantastic program. It's a really good rate. It does not change. There's no prepayment penalty. It's great, and you need 3% down. 3% down, right? On that $500,000 house, that's $15,000.
Yeah,
it's not bad.
That's kind of doable.
And here's the thing. I probably get at least a person every other week where I do tell them, now is not the right time for you to buy, and this is why. Homeownership isn't for everyone at any given moment. You have to be financially and personally ready to own a home.
Yeah.
And sometimes that is making sure that you have the ability to save enough to get a down payment. And I know that's difficult for a lot of people. I know a lot of people live paycheck to paycheck. But on the flip side, understand you own that home. Your water heater goes out, you got to pay for it, buddy. It's not your landlord.
Yeah.
Your roof needs replacing, that's a $15,000 bill that you are paying for. So the ability to budget and save is critical to being a homeowner. Well, I think that's a pretty easy entry also, is showing that you can budget, that you can save, etc. I'm not saying $15,000 is easy to save, but I am saying I think it's reasonable when you look at what is coming in your future on the housing world.
Yeah, absolutely.
To be able to save that.
Yeah, it's kind of a full-time job in and of itself to own a home.
It is.
If you're going to capitalize on the fact that it will grow in equity over a period of time, but that comes with the fact that you have to maintain it. You have to make sure that, nothing is going wrong with the property. If, you won't get that equity if you let that the leak in your roof continue,
right.
or you have some plumbing issues. Yeah, you have to keep on it. And no, I think that brings up a good point about how there's kind of a bar to entry with homeownership, with that responsibility that comes with saving and comes with the responsibility of having to take care of it as well. And yeah, homeownership isn't for everybody.
Right.
And that's okay.
Right.
That's just, everybody's different.
We get a lot of people that want to own a home. We run all their financials, we run their profile, and we find out that, hey, you actually can't quite qualify, or your qualification is $220,000. Well, you know as well as I do that actually doesn't exist.
No, that's impossible right now.
So the goal is to, if someone is not ready right now, let's put them on the path to success.
Mm-hmm.
If they have poor credit, rock on. Let's figure out how you're going to raise your credit. If they don't have the down payment, let's make sure that you are structured to be able to get that savings set up so you get that down payment. If they're just not ready because of their job, because of whatever it is, let's look at your credit. Let's look at your income. Let's see if there's any way that we can put you on a plan to reduce some of your other expenses so in a year or two you can buy a home. The answer is never no. You just can't buy a home. I'm sorry. It's you can't buy a home right now. This is what you need to do in order to buy.
Right.
And by the way, I'm going to be checking in with you every 3 months to make sure you're on track.
Hey, that's great.
It is so satisfying when you have people. I had in January, I had a person who I've been working with for 3 years. They had to build their credit, and they had to pay off a bunch of very specific items to be able to get that debt to income ratio in a certain spot. We've been working together 3 years, and they finally did it.
Awesome.
And ended up buying a house, and that is very, very satisfying.
Sounds like it.
Yeah.
I can relate to that. There's a lot of, it takes time working with buyers.
It does.
It's on this side of things too. Sometimes it's 2-3 years also of looking around, waiting for the right one, and yeah, you just gotta keep on it and
yep, you do.
Keep pushing forward.
You do.
So, what do you make of going back to the down payment thing? What do you make of these? I see a few advertisements for programs out there that are doing 0 down again.
Well, I mean, again, there's a catch.
Yep.
Right? Probably what they're doing is they're doing a secondary loan. So they're probably saying, hey, yeah, you don't have to have any down. We're going to give you a loan for the down payment. So your interest rate is going to be whatever, 7%.
Mm-hmm.
And then we're going to give you this loan to put as your down payment. And it's going to be great. You're going to pay, 14.5% on that little down payment loan.
Yeah.
And you can't actually pay it off within 5 years or there's a penalty. But yeah, 0 down, and then you're going to do this. Again, I really, really encourage people to understand that home ownership is a very big responsibility.
Right.
And if you just absolutely need that 0 down because of something that you're going to be kicked out on the street, otherwise your rental is going away, I don't know what it is. Okay, that can be an option for some people. By far, it is not in people's best interest to try to skirt the system and circumvent standards that are already in place to end up buying a house. Now, if you are one of those people that your income aligns with certain down payment assistance programs, et cetera, fantastic. Use it. Use it. That's why they are created. The challenge is that, again, the income that you make compared to the income standards the programs have, now compared to the house prices, simply don't align.
Yeah.
So it's extremely difficult to actually get in there. So most of the time, those, hey, 0% down program, come in and see us, they're just getting you in the door. And they're going to say, yeah, we have a 0% down program. Oh, yeah, you don't qualify for it. Hey, I know. Let's talk about this 3% conventional down payment program. Yep.
Okay.
Yeah.
Bait and switch, baby.
Yep.
All too often.
I know.
Well, let's talk a little more about the rate buy down, because that's becoming more popular.
Yep.
In recent years, in the last 2 years or so.
Yep.
Just give me an overview of how that looks. I'll just kind of explain it for people to
Perfect.
might
So
not understand.
there are two options. The first option is a traditional standard rate buy down,
Mm-hmm.
or a lot of people have heard of buying points. Okay.
Yes.
That means you're taking your fixed interest rate, your 7% interest rate, whatever it is, and you're putting money towards it up front, right out of the beginning, to buy that rate from 7% down to whatever, 6%. Okay. Let's pause right there. There's a couple, I'm going to really try not to get in the weeds here, but there's a couple pitfalls there. Number one, you can only actually spend a certain amount on that buy down and still pass what are called qualified mortgage standards. So you can't just buy it down to 3%. There's a certain amount that you can spend on a loan that is factored into a test. So you don't just have free reign of how much you can buy it down. Number two, that buy down is going to be expensive. It's going to cost you at a minimum several $1,000s to buy it down. Here's the challenge. Math. Rates are going to be lower in 18 to 24 months from now. I will hang my hat on that one. So why pay $3,000 now to buy your rate down 0.25% or 0.5% or whatever it is? Why pay $3,000 now when you're probably going to be refinancing within 2 years?
Mm-hmm.
What you did with that $3,000, you threw it away. Now, if you bought the rate down and then you kept it for 30 years, absolutely, that's a great idea. No one's going to do that. So when people want to do a permanent rate buy down, this is what I do. I will take how much that buy down cost them, and then I will take how much money they save on a monthly basis. And I will say, okay, great. Based on how much you save on a monthly basis, it's going to take X amount of months to make up for that initial investment. If that is more than, say, 24 months, don't do it, because you're probably going to be refinanced anyways and in a much better position financially with your interest rate in 24 months than you are with this buy down, so you're wasting money. So that's option number one, and a very unpopular option right now because of the impending market. Mm-hmm. And I think you can very clearly explain to people this isn't in your best interest. Then you have things called buy down programs. 3-2-1, 2-1, and 1-0 buy down. I'm going to explain a 2-1. Understand it applies to all of them.
Okay.
2-1 buy down is the first year. So let's say you lock a loan at 7%.
Okay.
On a 2-1 buy down program, the first year the rate is 2 percentage points lower. You pay 5% interest rate on that loan for the first 12 months. That's the 2 in the 2-1 buy down. The second year, now we have the 1-2-1 buy down. You pay 1% lower. So the second year, you pay 6% instead of 7%. The third through 30, you pay your standard 7%.
Okay.
That 7% does not, it cannot fluctuate. It is a fixed rate, but the first 2 years, it is significantly reduced. What that does is it allows that purchaser of the home to have significantly lower payments the first 2 years. to the point I just closed on one about 2 weeks ago on a 2-1 buy down. It was about $600 a month difference the first year, $300 a month difference the second year. They're banking on the fact that within 2 years, they're going to end up refinancing that house at a lower rate.
Right.
So it really is a huge tangible benefit to the borrower because their payments are so severely reduced. And here's the beauty of it. If rates drop a whole bunch in a year, you can actually take the residual money left over and you can apply it directly to your principal. So for the buyer, you don't lose anything, but the seller has to finance it.
Oh, okay.
On those buy downs, the seller has to have the seller concessions to finance it. So if it's going to cost $13,000 for that buy down, you need the seller to buy the $13,000. That is the most advantageous way to do it. There are some one-off programs where the buyer can do it, et cetera, but don't do them. They're not. They don't math out.
Okay.
So the seller concession programs are the best programs out there.
Okay, that's kind of that's the catch to it.
Yeah.
It would be more challenging to get a seller too.
But I think it is highly underutilized by realtors as a selling tool. Here's why. You have a $500,000 house and it's not getting a lot of traction.
Yeah.
And likely it could not be getting a lot of traction because that mortgage is really high.
Yeah.
I mean, people have a problem paying $3,500 a month for a mortgage, right? So you can either take that $500,000 house and you can lower by $20,000. Okay, now you're at $480,000. Well, what you did is you affected the payment by $100 maybe. Or you can say, hey, $500,000 house, but Mr. Buyer, I'm going to give you enough money for a 2-1 buy down. So your first year payment, you're going to be paying $500 less. Second year, $250 less. I'm helping you out by helping you have significantly lower payments. And what it did is it cost that seller of the house $13,000 on the buy down. Again, I'm just coming up with a ballpark number, versus lowering their payment, or I'm sorry, lowering the house price by 20, 30, 40, 50 grand to make it more attractive. So I think that for the sellers of the house, it is a very underutilized kind of tool to help them retain as much of their money as they can, but still make it attractive to people coming in to try to buy.
That's a very good point. Great advertising right there, yeah. I think that definitely could be utilized a little more.
Yes.
From the selling side.
For sure. We have to be creative, right?
Yeah. Oh, yeah, absolutely.
Yeah, it's a huge benefit to the buyer, and I think it helps the seller retain more of their equity.
Very nice.
Yeah.
All right.
Yeah.
You spoke earlier that you don't believe that the market's going to crash. Everybody's been saying it for a while.
Of course.
I hear it all the time. I personally don't believe it, and I have my reasons too. But coming from people often don't believe a realtor when they're saying that because you just want to push prices higher so you can make more money.
Right.
I mean, no, that's we list things by looking at the market and what things are selling for.
Right.
You know, what people are willing. Actually, it's more what people are willing to pay for houses. And that's where we price things. It's not necessarily that we're coming up with those prices. It's we're looking at what has previously sold and what's on the market, and that's where we kind of determine price. And I don't believe it's going to crash due to certain economic winds that are coming through. But what does that look like from the aspect of a mortgage broker?
So first and foremost, I will say I do not have a crystal ball. I don't know that it's not going to crash.
No, of course not. We don't know these things, but we can sort of predict.
Yes. Here's the thing. When we look back in 2008, 2009, and we see some of the biggest catalysts of that crash, that was devastating to our economy on a national level.
Yes.
The government understands that, and the government fixed a lot of that. First of all, I'm not joking when I say that you could do stated income loans at that time. You could literally walk into a mortgage broker and say, I make $100,000 a year. And they'd say, you do? Cool. Sign this piece of paper saying you make that. Let's go.
Yeah.
You didn't have to prove it. Stated income, buddy.
Great model.
I can see how that would maybe have a little bit of a detrimental effect. Maybe. When the economy starts to go slower and, you don't make $100,000 a year, and now you can't make your house payment, now you foreclose on it. Supply and demand is a reason why I say there's not a chance in hell that the market's crashing anytime soon. When you look at the demand that is out there versus supply that is on the market, it is grossly misweighed.
Mm-hmm.
People want to buy houses. There's a ton of people in the market, and there's not a bunch of things on the market, not nearly enough to support the supply.
No.
When you have that supply and demand that is so out of whack, why do they have to lower? The housing market doesn't have to give up any of its pricing because there's plenty of people out there willing to pay for it. Just like you say, a realtor's job is to list a house at what they think it can sell for, and your job is to get that seller the most money you can from their house.
Yes.
That is your job and your duty. So if everyone is paying $500,000 for a 3-bedroom, 2-bath house on this street, and a person wants to list their house on that street, if you go in and you say to them, hey, I think these are overpriced, we're going to list it at $450,000. You know what they're going to do? They're going to go to the next realtor who knows they can sell it at $500,000.
That's right.
So the market doesn't support a large decrease in price because they're willing to pay it. And until we have enough people say, you know what, I'm not willing to pay it, and the housing market significantly slows, and it's flooded with inventory compared to buyers, housing price is not going to significantly change. And that's not going to happen anytime soon. It can normalize, meaning if things are getting inflated and that $500,000 house really should sell for about $480,000, when more things come on the market and there's more different options for people, it's very possible that that house is going to have a price correction and maybe come down to the $490,000, $480,000 area. But it's not going to go from $500,000 to $350,000.
No.
Like a lot of people are thinking.
It will, yeah. Retraction is normal. But like you, I don't believe it's going to crash. I mean,
Right.
we're in a period of low inventory and still relatively high demand.
Yep.
I'm seeing all the time that we have just about as many houses going under contract as there are new listings coming on. So we're not increasing our inventory very much.
Right.
I mean, maybe 1%, 2%, or 3% over the course of a few months, but not a whole lot, not enough to justify now that there's a lot of options for buyers out
Right.
there.
Yep.
That's one of the big problems that I'm facing right now with many clients that I'm working with on the buying side is that there's just not a lot of options out there. And there's, they're trying to find the right one and it's a little difficult.
Yes.
And also we're in an inflationary period. We're seeing a rampant inflation still after several
Yes,
years.
we are.
So how do we expect prices to decrease in one sector of the economy when they're increasing in every other sector of the economy as well?
Yep. Exactly.
I mean, you can't home building and construction in this country is what drives
Right.
a lot of the economy.
Right.
And you see those materials still increasing in price. Oil's going up again. Everything is still increasing.
Yep.
And, we have a kind of two factors going into the housing market with high demand, low inventory, and also it's becoming more expensive to build a home
Right.
as well. So
Right.
we're not going to be seeing, I don't think, a big dip in prices with those people waiting in the wings of like, all right, I'm gonna wait until this house comes down to $350,000 because that's what I think it's worth because that's what it was in 2018.
Yep, I agree. And then that's our job, right? That's
Yes.
our job is to try to explain to those people. And you know as well as I do, sometimes you get people really angry at you
Oh, yeah.
for explaining that.
Oh, yeah.
I mean, they get mad. It's like you yourself are the one that are keeping these prices high. It's like, no, I'm simply telling you what the market is, what the world is right now. And I'm here to help you find a solution, but I can't change the house prices. I can't change the interest rate.
Right.
I can't do anything about that, but I can help you build for a purchase later. Yeah, it's tough.
Yeah. All too often in those situations, I find realtor becomes a 4-letter word.
There you go. There you go. Yeah.
Yeah. People get upset.
Yeah. Oh, yeah, they do.
They're like, oh, I get a call and they're like, hey, I'm looking for a house in Hamilton or Corvallis or whatever, and it's like, all right, what's your budget? Are you pre-approved?
Uh-huh.
No, we're gonna wait. It's like, well, that's a different story of like, trying to get people to, well, we need to have a conversation with a lender before we start going out and looking at places because we need to know what you can afford. Or it's like, well, I'm looking for something, in the $150,000, $200,000 range. Okay, land, right? No, like a house. It's like, well, I hate to break it to you, but I mean, unless you're looking for a mobile, it's not gonna happen around here anymore.
Yeah, it's funny. I will see a lot of times I try to stay out of comment sections on different posts and everything like that, but sometimes I will see people just flat out blaming realtors for the increase in prices around here.
Oh yeah.
And just like that, that example I gave earlier. I mean, if every house on the street is sold for 500 grand, and a realtor comes in to list a new one, you're going to list it at 500 grand.
Yeah.
You may even list it at 510 because everything else is sold at 500.
Yeah.
That's your job.
Yep.
And by the way, for the person selling the home, that's what they want also.
Yes.
So you're simply doing your job.
Yeah, I'm like you said, I'm doing my job and my duty.
Right.
When I'm representing a seller, my duty to them is to get them the best price for their home. And yeah, we're going to analyze market data.
Yep.
We're going to look at what's sold in the area, look at also what's on the market in the area.
Right.
And there's no way that I'm going to list it, 10, 20% below what everything else around there has sold for.
Right.
Doesn't make any sense.
It doesn't.
And they're not going to hire me for my, for the business.
Yep.
If I come to them with that.
Right.
Now, on the other hand, we do see too often that certain people have an idea that their home is worth a certain price, and the realtor is willing to list it at that price, even though there is no data to support that home could sell for that value.
Sure.
That's what one of the brokers here in the office calls buying the listing.
Yeah.
And that does happen. So there are some times where you do see a home that is overpriced, but the market will tell you pretty clearly after a period of time that the pricing's wrong.
Right.
And you'll have to decrease and readjust. But
there you go.
I think that's more common than underpricing.
Right.
And if it's underpriced, well, there might be something going on there too. But that's a different story.
Yep. So yeah, I think a big thing is getting people educated on what it takes to buy a house and setting them up for success. And I think those steps are pretty clear. You have to have a good job. You have to have consistent income. It's actually called the ability to repay rule. You have to be able to prove that you can pay back this ginormous loan that you're getting. I think that's fairly reasonable, right?
Yep.
So you need to have a consistent job. By the way, everyone, if you're not 40 hours a week, consistent every single week, and your hours vary, you're typically going to need 2-year history of that job in order to qualify.
Right.
So the 40-hour consistent or salaried position is typically what you need. You need that consistent job. You need to have decent credit. The higher your credit score, the lower your interest rate, the cheaper your payment. Mm-hmm. Don't underestimate credit. Oh, and by the way, don't also freak out at your mortgage broker when they insist on pulling your credit. That's part of our job. We need to see what is on your credit, what the scores are, and what your recorded liabilities are to do our job right.
Right.
It is not going to have a humongous detrimental effect on your credit like it could have 10 years ago. The algorithm has changed a little bit. It's not going to absolutely kill your credit anymore. Okay?
Yeah.
But we have to do our job. And if you're working with someone, Rocket Mortgage, that does not pull your credit and gives you a pre-approval, run away from that person because they're not doing their job.
Yeah.
So you have to have good income. You have to have decent credit. You have to have not a ton of liabilities. Guys, if you're paying for a car and a motorcycle and an RV and a boat and student loans and all of those payments are going to factor into it. That's more important to you than buying a house. Mm-hmm. So you can't have a ton of liabilities compared to how much income you have. And then you need to make sure that you get pre-approved with the mortgage broker first before you go out and look at houses.
Yes.
I tell people this until I'm blue in the face. I will say every year I have at least a dozen times, and I'm not exaggerating, at least a dozen times where people flip that. They go out, they look at a house, they find the perfect house. Oh my God, this is exactly what I want. Mm-hmm. Then they come to me to get pre-approved, and one of two things happens. One of three things. Number one, and by far the least often, is we get their pre-approval, and you're right, they can afford the house, and here we go, and they buy it. It doesn't happen much. The other two things is we run their info, and they can't even come close to affording that house. Yep. And then they're pissed off at me because they just found their dream house, but I'm telling them they can't afford it, so they're going to go to another mortgage broker. We all have the same rules.
Yep.
We all have the same debt-to-income ratio. So, or the heartbreaking one is they come to me, they go for their pre-approval, and they can buy the house. and it's under contract before they get it all done. When you come to me, I'm going to give you a list of documentation, things to do. It's going to take you an hour out of your life. If you take an hour and get it to me and I can work on it right away, you're going to be pre-approved within an hour probably.
Awesome.
But it doesn't happen like that. I'm going to give you the list and you're going to work on it. You're going to hem and haw. You're probably going to take a day, 2 days, 3 days, 4 days, 5 days. Then you're going to give it to me in little bits. And then when you give it to me, I'm going to have 6 other people that have given it to me sooner than you.
Right.
So you don't jump the list. Once you get me everything, then you're on my list.
Yep.
Then I'm going to work on it. By that time, maybe it's 5 days after you've seen the house and it's been under contract for 3 days.
Yep.
So get pre-approved first.
Yes, that is one thing that I am proud of that I've been able to incorporate into my, I guess, introductory phase for buyers when I get a call from someone who I haven't met yet, or they're just inquiring, hey,
Right.
I want to know about this. It was a little uncomfortable at first, so I've only been doing this for 2 years. I'm relatively new in the game, and I'm quite proud of myself that I was able to incorporate this early on, because it was a little uncomfortable to be like, hey, are you buying,
Yep.
to ask someone directly, are you, about their financials,
Right.
Because it's a little bit taboo
Right.
in situations. And so, but as soon as I started doing that, it freed up so much time, because it stopped wasting my time.
Yep.
It stopped wasting the buyer's time.
Yep.
Like, hey, are you pre-approved? Are you gonna be financing this purchase, or is it gonna be cash? Okay, if you're financing, have you spoken to a broker or a lender, your bank, somebody about getting a loan? Do you know what you can afford?
Right.
And that has removed so many hurdles and made the process so much more smooth when we know what they can afford. And it's not, we're going out and looking at a bunch of houses that they want to look at that they would never be able to afford. That's a waste of my time,
Right.
and frankly, a waste of their time. And so we can get a clear idea of, okay, here's what you can afford. Here's homes in that range. Let's go have a look. And then if you're ready to buy, we can make an offer.
Yeah.
We don't have to wait until we have to get the loan approved and do
Yep.
all that, because there are people out there that are ready to do it,
Right.
and they're going to get that home under contract before you.
Right. And you're a rarity for that, I will say. Every realtor says that. I can tell you from very personal experience, they are full of it.
Yeah.
Very few realtors will actually hold that line.
You have to. I
would
mean,
think so.
It makes it so much easier
Yep.
on my end too.
Yep.
To have that screening process beforehand.
Right.
Don't get me wrong, I love showing homes. I love helping people go out there, and we make a day of it. We go
Right.
out and we look at the houses, and we all talk, we talk about it, and oh, that's cool. I really like this thing.
Right.
It's a good time, and especially with new people from the area. I can show them around, give them a little tour. I love doing that part of
Yeah.
the business. It is so much fun. But I don't want to do it for someone who doesn't know what they can afford.
Right.
It just doesn't make sense.
Yep.
This is also my business.
Right.
My time costs money.
Yep.
And it's not that it's not a personal thing, even though, financials can be taken personally.
Right.
I mean, that it is a sense of personal responsibility that you have
Yeah.
a good sense of economics and,
Yep.
and this sort of thing in your personal life. But let's make sure we do this correctly and
Right.
efficiently.
Right.
That's all I ask.
And that's the last part of that setting up for success equation, I think, is getting the right realtor on board with you. Number one, you need to get the realtor that you jive with on a personal level.
Also,
right? You
yeah.
can't have that oil and water. It's not going to work.
No.
So you need to get that personality that you jive with. But I also highly encourage people that are getting with realtors who are proactive. And a lot of what I mean there is that, okay, if you're working with someone and they're a vet and they're qualified with Navy Fed, we know that a good mortgage broker is probably going to beat their interest rate by 0.5%, but they're with Navy Fed. A good realtor is going to say, hey, that's great that you're pre-approved with them. I also think you should get a second opinion and talk to a local mortgage broker here. Call this guy.
Right.
Because if you save them money, you're going to be here on the process. And your job is to have your client's best interest in mind. If you know that they just went to their bank, you get this all the time. Well, yeah, I bank at Wells Fargo, so I'm just going to them. I hate to tell you this, people. They're not going to give you a good mortgage interest rate. So by a good proactive realtor saying, hey, I know you're doing this is fine, but please consider doing this also and getting this option. You're being good proactive realtor that is going to end up saving them money. Same thing if you know that they're going to go Geico home insurance. I know darn well you're going to say, hey, you should really talk to, Taylor King at State Farm. You should do something like that also, and then weigh your options, because if you have a claim, you're going to hate life if you're with Geico. That kind of thing, because you're serving their best interest. So I really think getting that realtor who is not just a yes man, getting the realtor who has a backbone that can stand up and say, hey, I think you should do this and this is why, is imperative to having a successful transaction and saving the client as much money as possible.
Yes, I mean that's part of our job and our duty is we're here to give you the best information and help you have the best experience as well as the most information, and help you make the best decision that you can make.
Right.
It's not simply that, yes, I want to get you under contract so I can get paid.
Right. There you go.
I mean, that's all too often the conception of what realtors doing is like, oh, we're just going to drop paperwork and then I get paid.
Yep. There you go.
It's like, no, it's a little more than that. We're helping you. This is probably the largest purchase you're ever going to make in your life. Let's make sure we do this right.
Yep.
Let's give you all the options. We'll put them out there for you so you can make the best decision.
Right.
You can save the most money you can and have a great time doing it.
There you go.
As well. I mean, it's a mix of service and fun, and
I agree.
You just got to make it fun.
Yep.
Well, I think that's a good spot to end it on.
All right.
Dave, why don't you tell people how to get in contact with you, where they can find you?
Sure. So a couple different options. Just Google Montana Family Mortgage. Again, you will see our website. You can go there. You'll see my info there, as well as all my other loan officers. You can get in contact with us directly that way. My email is davek@montanafamilymortgage.com. Or you can always give our office a call, which is 406-926-6388. Christy, who's our client experience liaison, has the phone. She can take your information and get you in touch with whoever of us is currently available to make the turnaround very, very quick as well.
Awesome. Well, thank you again for being here. I appreciate
Thank
your
you.
time. And see you at the next one, folks.
All right. Appreciate it. Easy
Beautiful.
enough. Cool.
Thank you, sir.
So what did you do before this?
I worked. I went to culinary school.
Really?
I worked in restaurants for like 15 years.
Really?
Yeah.
Okay. And so what brought you here? What brought you doing this?
Well, I grew up here in the Valley, and then I left for a period of time and traveled around. I went to school in New York and worked in New Orleans and Texas and San Francisco for a while, and then ended up going to Europe for many years and found a job in Germany and was cooking there for a long time as well. And then